Hey there, everyone. Surprise, and welcome to a random 8 o'clock p.m. Eastern Time live market recap. Chart this with Dave Keller. I was going to record a show and sort of post it, and I thought, hey, if anyone's ready to watch, I'm ready to talk charts. So why don't we do it? Sorry for the delay today. I'm Dave Keller here with Market Misbehavior, coming to you from a dark and kind of rainy, very Seattle-like New York City. It's been a fantastic week here doing some events for the CMT Association. Earlier today, we actually did a special event at FINRA and actually hopefully built continued some positive relationships with the regulators here in the U.S. Talked to a group of FINRA representatives to help improve their market knowledge, just to educate them on how technical analysts look at the markets, and had a really good time hosting a panel with Mark Newton and Tom Lee of Fundstrat. Ari Wald of Oppenheimer, and co-hosted that panel with Adolfo Rueda from FINRA, who I've known for a number of years. It was a lot of fun, actually, and this week has been a real pleasure to reconnect with some legends in the industry. I do have to share one quick anecdote. Ralph Atkimpor, I've seen a couple times here this week, and he actually spoke yesterday, I want to say, at an event at Bloomberg. And one of the ways he described what we do as technical analysts, he said one of the things he learned earlier in his career was he was competing as an investor against investors and institutional investors that had way more and better information than he did. So he had no hope of informationing those people or having more access to information. But he said what those really smart and well-informed investors did, they would leave footprints in the sand. And technical analysis is about following the footprints, following the trails, and analyzing the trends. I thought that was a brilliant way of describing what we do as a technical analyst. Hopefully this show, Chart This with Dave Keller, helps you navigate and find those footprints on your own. All right, let's check out what the market are doing. We're going to do a brief show here because I know it's late here, East Coast time, and I am heading back to Seattle first thing in the morning, so I need to get to bed. But I do want to just update on what's happening because it's pretty busy week, but especially a busy day, right? After NVIDIA's earnings, after the close yesterday, the question was going to be what happened today and what sort of follow through or what sort of rotation do we see? What we'll notice as we go to the market recap here is that the major averages actually opened quite a bit lower, right? And you saw the S&P, the NASDAQ, accelerating to the downside in the first hour of trading or so up until around 10:30 Eastern. From there, kind of a nice 180 turn going back to the upside. The S&P got just about 59.60 at one point. End of the day, just below 59.50. That's still up 0.5% from yesterday. So not bad. After NVIDIA looked kind of questionable there at times here in the last 24 hours or so. The NASDAQ did end up finishing right about at the zero line. The NASDAQ was, really clearly the worst performer of this basket of indexes, had gone just above the zero level and essentially ended up right at Wednesday's close. The Dow is about 1% higher. Mid caps and small caps, your best performers though on the front page. The S&P 600 and the S&P 400 mid cap indexes both up about 1.7%. The VIX slightly lower actually, which usually happens. So when you have an update, you have volatility going a little bit lower, right below 17 at the end of the day. Looking at the interest rate environment, and I'm still kind of processing all the conversations I've been able to have here with some of my peers in the industry, and I was able to participate in the panel on Wednesday, and then host a panel discussion today, market outlook kind of discussions. And interest rates came up quite a bit. And one of my favorite charts that someone shared, which I'll try to probably incorporate into the show here probably next week, was looking at a really long-term chart of the 10-year yield. When I do the show from home, by the way, one of the charts behind me in the background is a long-term chart of interest rates. And it's for that same reason to remember that, interest rates essentially were in an incredible decline because bond markets were in a multi-year, multi-decade rally phase that went into around 2019, 2020. And from there, we've 2016, 2017 into 2020. And then you've seen a real rotation higher in rates. And I would argue that the secular trend in rates is higher. Now, there was a lot of disagreement in panel discussions that I was participating in as to what the short-term direction was. I would say, generally speaking, most people were kind of bullish on rates, right, or bearish on bonds, and expecting rates to generally be trending higher, and that was sort of the primary trend to keep in mind. But in the short term, quite a bit of disagreement. Some people suggesting the 10-year could go much lower. So I would argue people that are looking at these markets very closely still unclear as to what might be next. For today, for example, 10-year yield just about 4.4%, 5-year point just a little below there, and the long bond yield just about 4.6%. Dollar index up about 1/3% today. Commodities kind of mixed here. You can see the GLD, the gold ETF, was up 0.8%. Energy, in the energy part of the commodity space, your big gainers, the crude oil ETF, the USO, is up about 1.6% today. Cryptocurrencies overall continuing this impressive incline as Bitcoin did not quite get to 100,000 today, but really close, actually tagged 99K for the first time in history. That was just earlier today, Eastern time. Currently trading just above 98,000. I would say the general opinion I heard, and I was able to, again, moderate a panel with Tom Lee today, who's, been very correctly bullish on the crypto space for quite some time. And his suggestion was, quote unquote, much higher was the answer when asked about what he saw next for cryptocurrencies. Pretty bold up, I would say. All right, looking at the 11 S&P sectors, you can see utilities number one up 1.7%, financials, industrials, materials all up about 1.25%. So really rotating more to the value-oriented parts of the market, some defense in terms of utilities. On the downside, the only one of the 11 S&P sectors that finished in the red, communication services. Now, as we'll see from the market carpet in a few moments, the Alphabet, just absolutely got crushed today, and that is dragging the XLC down as your lone red page, or a lone red value on the front page here, I would say. Looking at the Magnificent Seven and Friends, these mega cap leadership names, you can see Netflix up about 1.5%, Nvidia up 0.5% after earnings yesterday. Now, the results after earnings, I guess the reaction was very mixed. It was down in the aftermarket. It was up in the pre-market. It ended up being pretty choppy today, but at the end, still up about 0.5%. On the downside, as I mentioned, Alphabet, your worst performer, down almost 5% today. Amazon also down over 2%, which is not great. Quickly looking at the market recap here, and as a reminder, when we look at the market, the market carpet here, we do three things. And I should note here, someone asked about the bomb cyclone. Much of the east side of Seattle, which is where I live and where my office is, and all of those sorts of things, still without power. And actually, downtown Redmond, which is where Stock Charts is located, not expected to get power back until Saturday at the earliest. So still no power there. So I'm very happy to see that the Stock Charts platform is running just fine today. That was good. I know that's a lot of effort to get things back up and running, particularly when the whole area has been knocked out. My family, thankfully, was only out of power for about 12 hours. And many of the people around us, even in our community, are still without power. So I hope everyone can stay safe. Luckily, the damage was pretty rough, but mostly people survived it, just having to get through a stretch here as big evergreen trees, which we have a ton of in Washington, have to get removed from roadways and power lines and all that kind of stuff. All right, getting to the market carpet here. Alphabet, really, you're obviously the big story here. So number one, we look at the overall takeaways. Generally speaking, if you ignore Alphabet and Amazon, which are bright red and right staring you in the face in the middle of the market carpet, other than that, a pretty decent day, right? And a lot of sectors glowing pretty well in the green, which is encouraging. So I'm happy to see that general move earlier in the day, certainly right out of the open. As I was preparing for a panel discussion, looked pretty rough there, and all of a sudden felt like it might be a big time distribution day, and it was for some stocks, but not many. Generally speaking, and I would say this is a market where the breadth conditions have been a little weaker here recently. You're seeing a nice improvement. In terms of the big dogs, the biggest names, as I mentioned, Alphabet down the most, Amazon down as well. The others kind of okay, right? I mean, Nvidia up about 0.5% after earnings yesterday, but we can see Apple, Microsoft slightly lower, Meta, Tesla slightly lower. So it wasn't a great day for the Magnificent Seven. It was a pretty great day otherwise. And as you can see that from, the NASDAQ being flat and small caps and mid caps up almost 2%. That's what a day like this kind of looks like. And another anecdote I'll share from this week of doing panels in New York. Craig Johnson of Piper Sandler was on a panel with him yesterday at Bloomberg, and he said, is the Mag 7 becoming the Lag 7? So I will fully credit Craig with that one. That's the first time I'd heard that. I love it. And today, perfect example of what has happened. I think there's a lot of strength to be had outside of the Magnificent Seven stocks, outside of the Magnificent Seven sectors. Look at the sectors that are doing well today. It's the cyclicals, it's the value-oriented sectors like financials, like industrials. I would argue going into next year, that's where I'm certainly seeing a lot more potential opportunities. Finally, just the smaller outliers and smaller movers. I would say I'm looking at some of the big box retailers like a Costco up about 3% today. That's kind of nice leading to the upside. Within healthcare, which has actually had a pretty rough stretch here in recent weeks, actually doing okay. Things like Merck and AbbVie up over 2%. That's pretty impressive. And also noticing some of the downside outliers within the financial sector, which overall did quite well. Market access actually in the red. TransDigm Group, TDG, Alaska Airlines, some of the other airlines. I feel like the entire city, Seattle, getting killed here. Boeing, Alaska, these are Seattle names getting dinged to the downside. All right, continuing, and to finish off our show, we'll go to the chart review, looking at the main chart of the S&P 500. As I've said many times, and I will continue to reiterate today, it's all about the line in the sand, right? When a market is going up, which it is, when the primary trend is higher, which I think it undeniably still is, we're making higher highs and higher lows. This is a Dow theory uptrend. The question is, when is this something different, right? When is there a change of character that tells you the trend is different? And I'm not seeing that yet. For me, it would be a push below 56.50, and anything above there is just kind of part of the normal noise within a primary uptrend. We break below 56.50, I won't be able to say that, because at that point we will have made a lower low. We've probably made a lower high. We've broken below the 50-day moving average. We'd break the 38.2% retracement level. All of those things would have broken if we get down to 56.50. That's my line in the sand for now, and I'm not updating it today. So as long as we remain above there here going forward, I think things are pretty good. And if and when this uptrend continues, then I think that's when you start to bump that line in the sand higher. But overall, in good shape. A couple other charts here to finish off the show that are top of mind for me. The McClellan oscillator did briefly get back above zero, and that's at the end of the day today. So the McClellan oscillator has been below zero for most of the month of November. It did go briefly higher there about a week in, but really since early October, the McClellan oscillator has generally been below zero pretty consistently. Now that is as the S&P has made higher highs and higher lows. That is what the market can do when the Magnificent Seven stocks are hanging in there okay, and other things are struggling. Breadth will be weak, but the trend will still be up. Now, I feel like we're almost getting a bit of a mean reversion to that signal here today, where you have the Magnificent Seven stocks lagging. You have breadth actually improving because it's all the other stuff that's starting to thrive. And if we do get into a scenario where financials, industrials, and healthcare and utilities start to do well, and technology and communication services stocks struggle, the benchmarks are most likely not going to go up a whole lot and potentially even start to go down if the Magnificent Seven stocks are struggling to the degree that they might. So I think that's where breadth is kind of an interesting read right now to just get a sense of leadership. Just wanted to reiterate the McClellan oscillator that was updated. And again, thanks to the stock charts team getting this all back up and running here, given the conditions in the Seattle area. The reason why that was able to trigger here earlier this week, getting to a +3, meaning all three parts of the McClellan oscillator were firing, was because we had at least 2.5% of the NYSE listings making new 52-week highs, and that same amount making new 52-week lows. Now that we've sort of eliminated that signal because the McClellan oscillator is briefly above zero, that actually reinitiates it. So starting tomorrow, the clock is going. Do we get a second confirmation? We have not had two confirmations within a month since the end of 2021. And before that was the COVID peak in February of 2020. This is one of those indicators that does not signal often, but when it does, it's usually at a major top. So given the rally that we've had in 2024, given how the end of 2021 looked with a market in a primary uptrend, the McClellan oscillator, breaking below the Hindenburg Omen firing and getting the double confirmation within a month, That's what the end of a significant bull market kind of looked like. And that was leading into a painful 2022. And I'm concerned that here, going into December of 2024, we're seeing a very similar configuration from one of those topping, classic market topping signals, indicators. All right, the Russell 2000 ETF having a nice day today. As I mentioned, small over large was the story today, which has not been the story for most of 2024. And this is certainly a bit of a change. I would say that the improvement in small caps is encouraging here. And part of that is a sector thing, right? Because if you look at what is the biggest weights in the S&P and the NASDAQ, it's not the same things that are biggest weights in small caps. This favors more value sectors. It's less growthy, more value-y. Things like financials and stuff would have a bigger weight in the small cap indexes. So the improvement in small caps, the improvement in the IWM, and certainly the relative performance at the bottom is going to be driven by things other than growth kind of dominating. Now, this conversation came up a lot with some of my peers during the week here in New York, and I would say there was a general takeaway that I would have from multiple conversations is a pretty encouraging outlook for small caps, and the fact that we've not seen the improvement on a relative basis is what we may be looking for. On an absolute basis, the IDMM looks great, right? It's made new 52-week highs. It's making higher lows. That's all good. But the relative strength has not been there because the S&P and the NASDAQ have done kind of similar things. Is this the new sort of small cap leadership phase? I think it might be, and it has a lot to do with, again, the sector themes. I did want to note, by the way, this is Thursday, Wednesday and Thursday. If you look at the bottom panel, about 6 to 7% of the, that's 67 out of 500 names, which means about 13 to 15% of the S&P 500 members making a new 52-week high yesterday and today's session. So the S&P is not making a new high above 6,000, but about 15% of the S&P members, 14% of the S&P 500 members actually made a new 52-week high today. It's kind of encouraging, right? So when you think about what would be the all clear that we're going to go above 6,000 and make further progress, this is the kind of thing you need to see a lot more green, meaning of those early leadership names leading the way higher. Survey data came out today. The AAII survey really coming off of a very bullish reading last week. Last week, we were almost to 50%. It was around 49% bulls. Today, it's down to around 41%. Bears have increased to around 33%. So bulls still outnumbering bears by about 8%. But that difference, that spread is actually narrowing. And so kind of a downgrade to the bullishness that we've experienced recently from individual investors. I mentioned my panel today where cryptocurrencies came up and on yesterday's panel as well. Overall, anyone I talk to that is technically oriented speaks to the clear uptrend. I would agree. Thinks to the upside potential. I would agree. Thinks of the fact that the long-term thesis is bullish. I would agree. In terms of the short term, the problem is we are getting accelerating moves to the upside, which means we become very overbought. That often means we're going to have some sort of pullback. But I would note that when we become extremely overbought with an RSI above 80, that usually means we're not at the end. And we talked about that a couple of weeks ago when we got to this point. And we spiked above 90,000 for the first time. And we noted that the RSI was above 80. And as we said, that means that we may get a pullback, but overall, there's such strong momentum. We call this the good overbought, probably going to have a little bit of a further upside. And that's, I think, what we're experiencing right now. In this kind of chart, I think of it as a trend follower. I think of it as innocent until proven guilty. I'm happy riding it higher until the chart tells me otherwise. And I do own Bitcoin in terms of full disclosure. 100,000, you talk about big round number resistance. That's one of those big round numbers. Here's NVIDIA. Now, we did sell off from the open. It was kind of a choppy day, not unexpected given earnings yesterday. And overall, I would say there was not this big upside follow through. If you're looking for the all clear of NVIDIA powering above 150 and just not looking back, we did not get that today. So we did close higher than yesterday's close, but we did go off from the open. I would say the divergences we've talked about, the concerning development that we've experienced with NVIDIA, I would say still there. I don't see a huge change after. You are seeing downward moves in stocks like Amazon, and that's a bit of a concern because we had a gap lower now a week ago, and now we've continued to make lower lows most of the last week. And that's a problem because what that gap looks like is what's called a breakaway gap, or an initial gap in a new direction, an impulse move to the downside. And so I think Amazon's starting to look a little more vulnerable here. Alphabet, though, by far the worst performer. Alphabet again is another example of where the Magnificent Seven stocks, which gapped higher or traded higher, or gave signs that they might be emerging into a position of further strength, kind of failing. And you have Alphabet actually today tagging its 200-day moving average. Now that has served as support a number of times here in the last 6 weeks. I'm not sure if that's going to hold again, but I do know we're right at an RSI of 40 as we test the 200-day moving average, which means this is kind of a key point. Can it hold that level? And if not, that's where something like Alphabet suggests much further downside. MicroStrategy, another theme that came up a lot here this week, semiconductors versus software. Software has been a much stronger part of the technology sector, but I do want to note the danger for software stocks like MicroStrategy that have had such a significant run. This is a stock just in the last 2 months has gone from around 150 to around 540 on an adjusted basis, which is a pretty significant rally. Is down about 16% today. And that, of course, if you know your candle patterns, that is a bearish engulfing pattern, an up day followed by a down day. That tells you a lot of distribution happening today. Suggests the next 1 to 3 bars more likely lower. Let's finish on a positive note, shall we? John Deere, I mentioned the industrial sector, some of the other cyclical sectors doing pretty well today. I want to highlight that John Deere had a nice rally up a good amount today. For the week, it's up almost 10%. And now what I wanted to highlight here on the weekly chart is we're very close to making a new multi-year high. This is when we think about charts like John Deere and you think about the rally we've seen just in the last week or two, or the last month or two, really. Think about what that means relative to the longer term structure. When you look at a weekly chart or a monthly chart, you can see that while they've had a pretty good run this week, this could be just the beginning, right? This is what we call a big basing pattern or a big base breakout. Ralph Ekampora, again, who is here today, quoted Alan Shaw, the great Alan Shaw, one of his mentors at Kidder Peabody at Smith Barney. And Alan Shaw used to say, the broader the base, the higher in space. So we have a multi-year consolidation, a multi-year period where this level around 430, 440 has served as key resistance. Do we finally break above that level? And if so, this measures much higher beyond current levels. Folks, I'm going to leave it there today because it is late. I'm going to bed so I can get back home to my family in Redmond, Washington. But I want to thank you guys so much. I'm so impressed that so many of you were able to join me here with no warning, being a couple hours late. But I appreciate you so much doing so. Thanks so much for watching me and following my work. No show tomorrow because I'm going to be getting back home. And then I've got family flying in for Thanksgiving. So I'll be enjoying that. We'll be back on Monday with a market recap between now and then. Number one, relax and enjoy life. And also remember, it's always a good time to own good charts. Have a good night, everybody.